Andrew's first idea is First Capital REIT, FCR. Can you remind us what kind of an outfit this is, Andrew?
So First Capital REIT owns retail shopping centers across Canada, focused on the grocery and pharmacy sector. We call it the best because it's the highest quality. How do we define that? They are in the best markets, really just 6 major markets in Canada. Think Toronto, Montreal. The strength and quality of their tenants also makes this one of the best, really shopping center portfolios globally. Think Loblaws, think Shoppers Drug Mart, liquor stores. You get a 4.7% dividend yield while you wait and watch the value of the portfolio grow. All that said, despite being the highest quality, it trades at the greatest discount to the private market value of its real estate or its net asset value. The company estimates it's worth over $23 per share, and we tend to agree. This company's been the subject of some activism lately. And we're hopeful that there will be some resolution to some near-term governance changes in response. And we're hopeful that there'll be a strategic review to help close this gap between what's a great portfolio and the market just not rewarding it as such. So while you wait, you get paid in terms of a nice yield, and we'll see what will happen in order for the REIT to close the gap.
Sun Communities, SUI in New York.
So Sun Communities operates in a sector that doesn't really exist in the public markets in Canada. They operate in the manufactured housing sites sector, where they own land and rent out that land to either RVs or manufactured homeowners. People just simply buy a home, put it on that land, and pay land rent. This really is one of the most defensive asset classes there is. Very affordable rents, and has always been a very defensive sector. We like that in this economy that we're sitting in today. The MHC sector has never had a year of negative net operating income growth. So sitting here today, when we look out into 2023, Sun Communities has already passed on over 6% rental increases to its MHC residents, almost 8% rent increases to its RV residents. And so we think that type of cash flow will look pretty attractive in 2023, while the shares continue to trade at a double-digit discount to net asset value. And really, that rarely ever happens. The sector typically always trades at a premium, so we love owning the stock here.
And then your final idea, American Homes for Rent, AMH in New York.
So just like Tricon, this company owns and operates single-family rental homes across the United States. They have over 58,000 homes that they rent out. And what's unique about this company is that they have their own in-house development pipeline where they can add another 15,000 lots that are homes on the lots that they own and have optioned. So we think the combination of what will continue to be a very attractive internal rent growth, as well as this external growth, will set them well for earnings growth in 2023. All at a time that the company trades at a 17% discount to the value of its shares. So at a time where housing is a big question mark in the United States in terms of the ability to own a home, you can now go out and rent a home of similar quality to one you would have bought from a builder. American Homes for Rent is simply building those homes and speccing them out for renters themselves. So great opportunity to own something in a very defensive asset class.